Hello everyone, welcome to the session on non-banking financial companies in India, also known as NBFCs. My name is Dr. Ragvi and let us proceed further. What are NBFCs? NBFCs are financial institutions that provide a variety of financial services which are similar to banks but do not hold a banking license. So they play a very significant role in Indian financial system by channelizing funds to capital formation, providing credit to underserved segments and meet the financial needs of small borrowers. Unlike banks, NBFCs cannot accept demand deposits because they are not having banking license, and in India only those who have banking license can accept demand deposits, and they are not the part of payment and settlement systems. Let us move ahead and see the role of NBFCs in Indian economy. NBFCs act as an alternative support mechanism to the banking sector by providing loans and credit facilities to unorganized sector, small businesses and local borrowers. In order to do so, they help in mobilizing savings and offering a wide range of services such as equipment leasing, hire purchase finance, loans and investments. The structure of NBFCs is very flexible and it enables faster decision making and customized services which help to meet unique client needs and enhances financial inclusion. The key differences between NBFCs and banks can be seen in these four areas, namely deposits, payment systems, RBI borrowings, and deposit insurances. Let us see one by one. Deposits, as far as NBFCs are concerned, they cannot accept demand deposits or provide services like current and saving accounts. Further, NBFCs are not part of payment and settlement system, and therefore the persons who are holding accounts with NBFCs cannot issue checks drawn on themselves, nor they can encash the checks which are drawn. Further, RBI borrowing, when this comes, NBFCs cannot borrow from the RBI, that is Reserve Bank of India, where banks can borrow from Reserve Bank of India because RBI is the lender of last resort for the banks. Further, the deposits with NBFCs are not insured under the Deposit Insurance and Credit Guarantee Corporation. So, any deposit with a NBFC is having that particular type of risk that it will not be recovered in case if a NBFC goes into liquidation. Moving ahead, let us see how RBI Act defines NBFCs. An NBFC is defined under Reserve Bank of India Act 1934 and other regulations as a company engaged in lending, acquisition of shares, leasing, hire purchase, and any other financial activity excluding agricultural, industrial, or real estate activities. It is also defined in NBFC acceptance of public deposits under the Reserve Bank Directions 1998 as a company that can be a loan, investment, or equipment leasing company. The broad classification of NBFCs can be done into three different categories. One is a deposit accepting NBFC, also known as NBFC-D. Then we have non-deposit accepting NBFCs, also known as NBFC-ND. And there are systematically important NBFCs, also known as NBFC-ND-SI. Let us see them one by one. A deposit accepting NBFC, also known as NBFC-D, are authorized to accept public deposits up to a specified limit and require an investment grade credit rating. Now, this investment grade credit rating means that it should be at least credit rated till A. A non-deposit in accepting NBFC, also known as NBFC-ND, cannot accept deposits from public and has to operate on borrowed funds. Further, moving ahead, systematically important NBFCs, also known as NBFC-ND-SI, are NBFCs with over assets of rupees 500 crore and are classified as systematically important due to their impact on financial stability. Let us see the major types of NBFCs by activities. The very first type is Asset Finance Company, also known as AFC. These asset finance companies focus on financing physical assets like vehicles and industrial machinery. So here these companies give out loans to finance these particular types of activities. Then we have loan companies. These loan companies provide loans for various purposes. Now, here the difference between asset finance company and loan finance company is that asset finance company provides loans or financing only for physical assets, while loan company provides loans for any or various types of purposes. Moving ahead, the third type is investment company, also known as IC. These focus on investment in securities and shares. Then we have infrastructure finance company, where these type of NBFCs provide long-term loans for infrastructure projects only. Moving ahead, the second type or second major type is specialized type of NBFCs. The very first type is core investment company, also known as CIC. Core investment companies invest in shares and securities of group companies and is regulated to ensure stability. Then we have infrastructure debt funds, IDF. These provide refinance to infrastructure projects and issue bonds for long-term financing. Moving ahead, we have microfinance institutions. These microfinance institutions or MFIs offer micro loans to underserved segments, especially in rural areas. Further, we have the fourth type, that is residuary non-banking company, RNBC, where they accept public deposits under regulated schemes. Additional categories of NBFCs include NBFC factors. These NBFC factors specialize in factoring, which involves purchasing and managing accounts receivable. Then we have mortgage guarantee companies, which engage in mortgage guarantee businesses. Further, we have non-operative financial holding companies, NOFHC, a holding company structured to promote new banks. Further, the last one is NBFC account aggregator, which provides consolidated account information across financial assets. Now, account aggregators are growing in number because here these account aggregators, what they do is that they would be collecting information from various financial companies and they would be making it easier for the particular investor or the particular person to make a financial decision by comparing the informations across different segments at one place itself. The functions of NBFCs include: first, credit provision. NBFCs extend credit to individuals and businesses that may or may not qualify for loans from traditional banks because of higher risk which are involved or longer gestation period of a particular project. The banks might not be willing to give out loans to them. As a result, they approach a alternative chain or alternative system in the formal financial system through the NBFCs. The second function of NBFCs is about wealth management. Managers under the NBFCs manage investments and offer financial advisory services in order to facilitate the investors to make sound financial decisions. Then we have leasing and hire purchase. Financial assets, these NBFCs, what they do is that they finance asset purchases through hire purchase and leasing services. So what is hire purchase? Initially, what the particular purchaser or the one who is purchasing the particular product or a machine or a tool would be doing is that they would be paying in installment to the particular bank or a financial institution, and while they are paying that installments, they are also using that particular asset. This is known as a hire purchase type of model. On the other hand, leasing means that the financial institution would be buying the asset and it would be lending it the asset for usage to that particular institution or an investor or a company to use it. So the owner in case of hire purchase is the one who is purchasing, that is the one who is using becomes the owner. In case of leasing, the owner remains the NBFC, but it is giving it to use for a very long period of time. The next function of NBFC is regarding financial inclusion. It enhances access to financial services for underserved segments of the society by enabling or by ensuring that those individuals and businesses who may not qualify under the traditional business banks are able to also procure some type of financial services in the formal financial system. Now, there are certain regulations which govern NBFCs. Among them, the very first regulation is regarding the Reserve Bank of India. The Reserve Bank of India regulates NBFCs to ensure compliances with asset quality, capital adequacy, and customer protection. NBFCs with investment credit rating and authorization from RBI only can accept public deposits, rest of cannot accept public deposits. Further, NBFCs are required to maintain a minimum capital to risk weighted assets ratio to comply with the prudential norms. Further, deposit acceptance by NBFCs. Now, as we have seen, not all NBFCs are authorized to accept deposits. Only those with a specific license from Reserve Bank of India can do so. The deposits can be accepted for a minimum period of 12 months and a maximum period of 60 months, with interest not exceeding a specified limit. NBFC deposits are not insured and repayment is not guaranteed by Reserve Bank of India, making them higher risk investment. So before any investor or any depositor deposits money with NBFC or any type of institution, they have to first check whether it is a NBFC or it is a bank. If it is a bank, it gets covered, the deposit is covered under the Deposit and Credit Insurance Guarantee Corporation. On the other hand, if it is any other type of institution, it is not covered under NBFC. The limit under the DGCIA norms is now updated up to 5 lakh rupees. So one account is insured up to 5 lakh rupees. This reduces the amount of risk that a deposit holder might be facing on his deposits. Moving ahead, NBFCs are also sponsors for infrastructure debt funds. NBFCs with adequate financial stability can sponsor infrastructure debt funds, that is IDFs, to raise long-term debt for infrastructure projects. Only infrastructure finance companies, IFCs, can sponsor IDF NBFCs subject to minimum equity contribution and other requirements as prescribed by the Reserve Bank of India. Further, the types of deposits and public funds in NBFC are: NBFCs can raise funds to public deposits, intercorporate deposits, bank finance, commercial papers, and debentures. The types of deposits accepted by NBFCs include public deposit, intercorporate deposits, and funds from banks and financial institutions. There are certain challenges which are faced by the NBFCs, which are covered under the 3 different heads. The very first challenge that they face is regarding the regulatory restriction. NBFCs, because they are not under the direct control of Reserve Bank of India, but are subject to strict RBI guidelines, and due to these guidelines, the deposit acceptance is somewhat limited. As a result, their growth gets hindered because of this particular strict RBI guideline. Then there is competition from banks and financial techs, that is fintech companies. Competition from traditional banks and emerging fintech companies make it very difficult for NBFCs to survive in the system. Banks on one hand are more trustworthy and are much more under the control of the regulatory framework. On the other hand, fintech companies, because they are emerging and they offer better services, they are able to pull the investors towards them. So NBFCs face a challenge, dual challenge from these two entities. Credit risk and NPAs, higher non-performing assets, especially when lending to high-risk segment, is there. That is, only those people who are willing to take the risk are able to or will be depositing their money in the NBFC further. As a result, the money that is flowing into the NBFCs for financing their own activities is very limited. That is the first point. Secondly, any person who perceives NBFCs to be risky will definitely avoid it. And those who know that they might be losing the money or they are not traditionally covered under the traditional banking system will be the ones who will be approaching NBFCs. Now, banks are risk averse, and due to this, they would be avoiding certain type of individuals. Now, these individuals are avoided because of certain risk that they are posing. Now, if banks are avoiding these risky individuals, come to NBFCs and the NBFCs finance their activities, and if they default, the NPA percentage in these NBFCs increase because of this reason. Now, the recent developments and reforms in NBFC sector include that RBI introduced a new regulatory norms for capital adequacy, credit risk management, and liquidity to improve stability. NBFCs are increasingly nowadays adapting digital technologies to compete with the banks and financial fintech companies to improve the service delivery and operational efficiency, but they are somewhat lagging behind. If we look at the future of NBFCs, with the regulatory reforms and adoption of technology, NBFCs are very well positioned to drive financial inclusion, but NBFCs are now expected to continue to cater to niche segments and underserved areas supporting the vision of the government for financial inclusivity. In conclusion, NBFCs are an essential segment of the Indian financial system, providing a wide range of services to underserved segments. They complement the role of banks in extending credit and promoting financial inclusion. With robust regulation and continuous innovation, NBFCs will continue to grow and play a significant role in India's economic growth. Thank you, and we will meet again.